Imagine a world-renowned chef working in a gleaming kitchen. You see tweezers, liquid nitrogen, foams, and gels. Every plate is a work of art, a dozen components arranged with microscopic precision. It's complex, it's brilliant, and it commands a high price. Now, picture someone in their backyard at a simple grill. They have a perfectly sourced piece of meat, salt, pepper, and a mastery of heat. They produce a steak that is, by any measure, sublime. Which meal is better? The question is a trap. The real question is, what was the goal? If the goal was to create edible art, the chef wins. But if the goal was simply to eat a delicious, satisfying meal, the person at the grill might have the better, and certainly more repeatable, strategy. We have been sold a story that investing is like that first kitchen. That to succeed, we need the financial equivalent of tweezers and liquid nitrogen complex algorithms, secret stock picks, and an encyclopedic knowledge of market timing. We're told that simple is for beginners, that real returns are forged in the fires of complexity. This story is one of the most expensive myths in modern life. The truth is, for the vast majority of people, building wealth isn't about becoming a Michelin star financial chef. It's about mastering the simple, powerful, and deeply effective backyard grill. It's about understanding that the pursuit of complexity often leads not to better returns, but to higher fees, more stress, and a greater chance of falling behind. The goal is to see how a simple, almost boring, approach can be the most powerful financial tool you will ever possess. To get there, we first have to understand what investing truly is, once you strip away all the noise. It's not about charts with squiggly lines or fast-talking analysts yelling on TV. At its core, investing is simply owning a small piece of a productive business. Imagine you own a tiny slice of the best coffee shop in town. When it sells more coffee, innovates with a new pastry, and opens a second location, the value of your slice grows. You are participating in its success. Now, what if you could own a microscopic slice of not just that one coffee shop, but of thousands of the most successful, innovative, and essential companies in the entire country, all at once? That's not a fantasy. It's the foundational idea behind modern investing. It's a bet not on a single company's fortune, but on the long-term trajectory of human ingenuity and economic growth. Over decades, economies grow. People create things, solve problems, and build businesses. By owning a broad piece of that economy, you are harnessing that collective forward momentum. Investing isn't about outsmarting the game. It's about owning the entire playing field. The most elegant tool ever designed for this purpose is the low-cost, broad market index fund. It sounds technical, but the concept is beautifully simple. An index is just a list of companies, like the S&P 500, which represents about 500 of the largest and most influential public companies in the United States. An index fund is a single investment vehicle that buys and holds shares in all the companies on that list, in proportion to their size. Think of it like buying a prepackaged, perfectly curated grocery bag. Instead of wandering the aisles trying to guess which single fruit will be the ripest or which vegetable will be the tastiest next week, you buy one bag that contains a small piece of everything in the produce section. You get the apples, the bananas, the kale, the carrots. Some will do better than others in any given season, but by owning all of them, you capture the overall nutritional value of the entire section. You've diversified away the risk of picking a bad apple. That's what an index fund does for your money. It's a disciplined, automated way to own the market, not try to beat it. This approach feels almost too easy, doesn't it? Our brains are wired to believe that high rewards must come from high effort and complexity. We look at the fancy chef of investing, the active fund manager, the day trader, the stock picker, and we assume their frantic activity must be creating superior results. They spend their days researching obscure companies, building sophisticated financial models and making high-stakes bets on which way the market will turn. It feels important. It feels smart. The surprising and well-documented reality is that it mostly doesn't work. Year after year, study after study shows that the vast majority of professional, highly paid, active fund managers fail to outperform their simple, unmanaged index fund benchmark over the long term. These are people with PhDs from top universities and access to more data than we could ever dream of. If they can't consistently beat the market average, what makes us think we can do it from our laptops on a Tuesday night? It is like believing you can beat a grandmaster at chess after reading one book on opening moves. The market is the grandmaster. The allure of picking the next Amazon or Apple is powerful. We hear the success stories because they make great headlines. We don't hear about the thousands of failed attempts for every single success. This is called survivorship bias. We see the one ship that made it through the storm, not the hundreds that lie at the bottom of the sea. Trying to find the needle in the haystack is a thrilling game, but a poor strategy. The index fund simply buys the entire haystack. Perhaps you're thinking, okay, even if the complex way doesn't work better, it can't hurt to try, right? What's the downside? The downside is significant, and it comes in the form of hidden costs that act like a slow leak in your financial ship. The first and most obvious cost is fees. The fancy chef charges a premium for their services. Actively managed funds have higher expense ratios to pay for the salaries of all those researchers and traders. These fees might look small, maybe 1% versus a tiny fraction of a percent for an index fund, but that difference is a chasm. Compound interest is the engine of wealth growth, but it works in reverse with fees. A 1% fee doesn't just cost you 1% of your money each year. It costs you all the future growth that 1% would have generated for decades to come. It's like trying to drive a car with the emergency brakes slightly engaged. You'll still move forward, but much slower, burning more fuel to get to your destination. Over a 30 or 40-year investing lifetime, that seemingly small fee can consume a stunning portion of your potential nest egg. The second hidden cost is taxes. Active strategies involve frequent buying and selling. Every time you sell an investment for a profit, it can trigger a taxable event. You have to give a piece of your gains to the government. Index funds, by their nature, are very passive. They buy and hold. This buy and hold strategy is remarkably tax efficient, letting your money grow with fewer interruptions from the taxman. But the most insidious cost isn't measured in dollars. It's measured in time and peace of mind. The person trying to beat the market is chained to the screen. They're consumed by quarterly earnings reports, geopolitical news, and the daily gyrations of the stock ticker. They live in a state of heightened anxiety, celebrating euphoric wins and agonizing over painful losses. The simple index fund investor automates their contributions and goes for a walk in the park. They spend their precious time and mental energy on their family, their career, their hobbies, and living their life. The most valuable return is getting your time back. This leads to the most important and perhaps most counterintuitive insight of all. In investing, your biggest enemy is not a market crash or a bad economy. Your biggest enemy is the person you see in the mirror every morning. We are emotionally compromised animals. We are hardwired to do the exact wrong thing at the exact wrong time. When markets are soaring and everyone is euphoric, our fear of missing out kicks in, and we're tempted to buy high. When markets plummet and the news is filled with doom, our panic response takes over, and we're tempted to sell low, locking in our losses. The true genius of the simple, automated, index fund strategy is that it acts as a fortress against our own worst behavioral impulses. By setting up regular, automatic investments every month or every paycheck, you are forced to buy consistently, whether the market is up or down. This is a powerful mechanism called dollar cost averaging. When prices are high, your fixed dollar amount buys fewer shares. When prices are low, that same dollar amount buys more shares. It forces you to be greedy when others are fearful and cautious when others are euphoric, all without thinking about it. The most important variable in your investment return isn't your IQ, it's your temperament. So we return to our two kitchens. The financial industry has a vested interest in making you believe that you need the complex Michelin star chef. They profit from complexity. They sell newsletters, trading systems, and expensive advice. They create an illusion of control in an environment that is fundamentally uncertain. They want you to believe that if you just try harder, research more, and pay for their secrets, you can outsmart everyone else. But the goal was never to become a financial wizard. The goal was to build a secure future, to fund a retirement, to pay for a child's education, to gain a measure of freedom. The person at the backyard grill achieved their goal of a delicious meal with less stress, less cost, and a higher probability of success. They focused on what mattered, a quality ingredient and a simple, repeatable process. In investing, the quality ingredient is the broad market, and the simple process is to buy it consistently, keep costs low, and let time do the heavy lifting. Success isn't found in a magic formula. It's found in a boring, beautiful discipline. It's the victory of a simple process over the fuel quest for prediction.